hour. But first, let's turn our attention to the market action. It looks like a sea of calm when it comes to the headlines. However, there's a lot going on under the surface. Earnings is one factor. Possible stimulus in China is another. We're close to all-time highs in the U.S., both for the Dow and the S&P. James Callahan, portfolio manager at Barometer Capital Management, joins me on the desk. Thanks so much for being with me.
Thank you, Amber.
Talk to me about sentiment. You know, when we're at these all-time highs, it seems incongruous with all these worries that we have out there.
I think over the last 6 months, really, sentiment's improved dramatically. You know, markets turned really nicely, and I don't think by any means sentiment is extended here. There's lots of worries in the world still, but here we are sitting at all-time highs in U.S. markets, and to be honest, it feels pretty good.
How about for the TSX, which, I mean, I beat up on it a lot because it hasn't seen those all-time highs, but it's only 6% away. At the same time, it's kind of like a sideways market. What gets you excited about the Canadian market?
So I guess specifically today, the materials sector is doing quite good on the back of the China news that you referenced. We like that. It's been, you know, as we move into an environment where we think that economically sensitive sectors start to outperform, materials should be a big beneficiary of that. So it's nice to see that today. I think also the Canadian banks have made a nice turn. We've gotten involved in a small way there after having little exposure for most of last year in the U.S. as well. So those two areas, I would say. And
within the financial group, the banks certainly have rallied quite a bit from the October lows, though for the month of January, they're down. Other parts within financials, you know, Fairfax, Onyx, they've been doing incredibly well.
Yeah, Fairfax has been a big position for us. We like the insurance and bank industries in both U.S. and Canada. They've been big for us.
Let's talk earnings that we're seeing. I mentioned that United Airlines is, I don't know if the results themselves were, I mean, the forecast was very nice. And investors seem to be taking comfort in that because it seems like for airlines, there's a lot of anxieties. What is the 2024 travel season going to look like?
And justifiably so. You know, the airline industry has been challenged for years. Historically, they're not great businesses. They faced cost pressures. In the U.S. specifically, the competitive environment is really severe. So I think these stocks have been beaten down with some good guidance for next year for earnings for UAL. They're getting a bit of a bump today, but it's not an area that we've been involved in. I do think when you look under the surface at UAL's results, you see strong transatlantic revenue, which probably bodes well for a name like Air Canada.
Well, that was going to be my next follow-up. At what point does Air Canada look interesting to you? Cheap, 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 under pressure, and the fundamentals in terms of they're doing the best in terms of revenue they've ever done.
Absolutely.
And yet, no love.
No love. The competitive environment in Canada is a bit better for Air Canada. And I guess anecdotally in my conversations with U.S. investors that focus on airlines, there's a lot of love for Air Canada because the dynamics are so different in Canada than they are in the U.S. So I think here we probably could own it, but we've been fully invested for so long, it's tough to put new positions on because the market's broadened out so nicely in the last few months. There's a lot to love, and we've been focused elsewhere.
Are you staying fully invested?
Yep, for the time being. You know,
what's that predicated on?
Core to our investment process is that strength begets strength. Here we set at all-time highs, feeling great. When you look at the U.S. market specifically, we've seen since prior peak in 21, multiple contraction, but we've seen good earnings growth. So the internals have improved, and the market seems to be quite healthy. The level of concentration in the U.S. is something to be concerned with and I think aware of. But the biggest companies in the U.S., with some exceptions, are the best businesses. So for now, we think strength begets strength.
And you're talking about the Magnificent Seven there.
I am, yeah.
Yeah, and all of them?
No, so we don't. We don't own Apple.
Okay.
We don't own Tesla.
Good. Those have been the worst ones.
Exactly, and that's been our process. We're actually net short Apple here. Our view is that the hardware market is just going to be tough. Apple trades at 30 times earnings, and it doesn't really grow. All the growth in the business has come from the services segment, which is under regulatory pressure. Last week, they had to open up the services segment in the App Store so that developers were able to process payments in a third-party manner. Apple is going to plan to recover some of those costs, but it might be challenging.
So net short Apple, what kind of downside are you hoping to capture?
I think just some underperformance versus the other the other names in the Magnificent Seven. We think it'll be an underperformer.
I want to just spend a beat on that because recently Bank of America upgraded it after a slew of downgrades. And I think today it just put it on its like really upgraded. It's one of its top ideas. And underpinning that was, okay, generative AI is going to force this whole new handset cycle, which I think we can pick at because we don't know what the products are. Buybacks, dividends, services growth. So those were the kind of three pillars they hung their hat on.
Yeah, I heard that. I think that we'll see in a few years. It's early to make that call because, to be honest, in the last few years, it seems like Apple's lost their mojo in terms of product innovation. The VR headset, didn't sell out as quickly as people thought.
Yeah.
iPhone upgrades have been not very compelling. And wearable segments under pressure, with the blood oxygen sensor and Apple Watch.
The issues they had, yeah.
Yeah, causing them to stop sales there. So we'll see. It's early.
All right, that's an interesting call. We'll continue to track that. Talk to me about industrials because, we got 3M today. And I contrast what was that a few weeks ago. It was Fastenal. They make nuts and bolts. Such a pulse of the economy. Seems to be firing on all cylinders. And then you've got 3M. With a bit more subdued outlook. Also, maybe a pulse on the economy, but they've got these other issues, so maybe that holds them back.
Exactly, and to be honest, 3M trades more like a consumer staples company than it does a multi-industrial. I think they're subject to the classic holdco discount. Maybe if they split up some business lines, they would get a higher multiple ascribed to those business lines, like GE today, and GE's actually performed quite well on the back of that plan.
When would you get excited about 3M, though? It's so cheap. It's got a 6% dividend yield, very unloved.
They could do some revenue growth.
Yeah, okay. That's simple. All right, James, thanks so much for joining us on the desk. A lot of stocks to talk about. That's James Callahan joining us from Barometer Capital Management.